In October 2026, as the S&P 500 touches record highs, a quiet fear moves through Wall Street because behind the celebration, many investors feel the shadow of 1929 returning once again. The screens glow green, champagne flows in trading floors, and headlines scream about new all-time highs, yet beneath this excitement, a deeper story is unfolding. In New York City, veteran trader Mark Dalton, who survived the crashes of 2000 and 2008, stares at his monitor and whispers that markets do not rise forever. He remembers how in 2007, everyone believed housing prices would never fall, and 1 year later, the global financial system nearly collapsed. Today, the S&P 500 stands near historic peaks, powered by artificial intelligence, massive corporate buybacks, and record levels of retail investor participation. Companies like Apple, Microsoft, Nvidia, Amazon, Meta, and Tesla have added trillions of dollars in market value in just a few years. In 2023, Nvidia alone shocked the world by becoming a trillion-dollar company almost overnight, driven by explosive demand for AI chips. By 2025, Microsoft and OpenAI reshaped the business landscape, pushing productivity to new heights and valuations to dangerous extremes. The Federal Reserve, led by Jerome Powell, tried to cool the markets by holding interest rates higher for longer, yet liquidity still flooded into stocks. In 2020, when the pandemic crashed the market, the Fed injected trillions of dollars to save the economy, creating a wave of money that still echoes today. That flood of cash lifted asset prices everywhere, from stocks to real estate to cryptocurrencies. But history has a dark memory, and in 1929, a similar euphoria gripped America. During the Roaring '20s, investors borrowed heavily to buy stocks, convinced that prosperity would never end. New technologies like automobiles, radios, and electric power created massive excitement and speculation. In October 1929, that dream shattered when panic selling triggered a chain reaction that wiped out fortunes in days. The Great Depression followed, bringing unemployment, poverty, and social unrest on a scale never seen before. Today, comparisons to that era are growing louder. Margin debt is rising again, meaning investors are borrowing more to chase returns. Valuations, measured by price-to-earnings ratios, are stretched to levels last seen before major crashes. Household savings rates are falling, while credit card debt is climbing to record highs. Meanwhile, geopolitical tensions from Ukraine to the Middle East and trade conflicts between the United States and China add constant uncertainty. Yet the market keeps climbing, defying fear and logic. In Silicon Valley, startup founders celebrate billion-dollar valuations even before turning profits. In Texas and Florida, housing prices surge as investors flip properties for quick gains. On social media, influencers promise easy wealth through options trading and meme stocks. The belief that markets only move upward is spreading once again. But economic cycles do not disappear, they only change shape. In 1999, the dot-com bubble convinced millions that internet stocks would make everyone rich. By 2001, trillions of dollars vanished, and many companies disappeared forever. In 2008, banks packaged risky mortgage into complex financial products, selling safety while hiding danger. When the housing market cracked, the entire system collapsed. Each time, warning signs were ignored. Today, the warning signs are flashing again. Corporate profits are slowing, even as stock prices keep rising. Consumers are spending less, squeezed by inflation and high interest rates. Small businesses struggle to survive, while giant corporations dominate the market. The wealth gap widens, leaving millions behind as markets soar. In Washington, lawmakers debate debt ceilings and spending bills, adding political risk to an already fragile system. America's national debt crosses new records, raising concerns about long-term stability. Across the world, central banks prepare for potential shocks, building reserves and emergency plans. Behind closed doors, hedge fund managers quietly reduce exposure, moving capital into cash, gold, and short-term bonds. Some legendary investors, including Warren Buffett, hold massive cash positions, waiting patiently for better opportunities. They know that true wealth is built not by chasing hype, but by managing risk. Yet for every cautious investor, there are thousands betting everything on the next rally. The fear of missing out is powerful, pushing people to take risks they do not fully understand. Stories of overnight millionaires drown out warnings of potential collapse. But markets are emotional machines, driven by greed and fear in endless cycles. When greed dominates, prices rise beyond reality. When fear takes over, selling becomes unstoppable. The question is not whether the cycle will turn, but when. In 1929, the crash began quietly, with small drops that seemed harmless. Then panic spread, and within weeks, fortunes vanished. In 2008, the collapse started in obscure mortgage markets before engulfing the world. In 2026, the trigger could be anything, from a major corporate failure to a geopolitical shock or a sudden policy shift by the Federal Reserve. One unexpected event can change sentiment in minutes. Algorithms now control much of the trading, accelerating both gains and losses. A small spark can ignite a massive sell-off in seconds. Yet even in chaos, opportunity exists for those who remain calm and prepared. History shows that the greatest fortunes are built after crashes, not before them. Investors who survived 1929, 2000, and 2008 emerged stronger by learning discipline and patience. They diversified, controlled emotions, and focused on long-term value. They avoided excessive debt and resisted the temptation of quick profits. They understood that markets reward consistency, not speculation. For everyday investors, the lessons are clear. Build a diversified portfolio across industries and asset classes. Keep emergency savings to avoid panic selling. Avoid chasing trends driven by social media hype. Focus on strong companies with real earnings and durable business models. Understand that volatility is normal and patience is powerful. Respect history because it often repeats in unexpected ways. The S&P 500 may continue to rise and new highs may still lie ahead, but ignoring risk is the fastest path to regret. As Wall Street celebrates record numbers, a quiet tension lingers in the air. Behind every rally stands the possibility of reversal. Behind every success story hides a cautionary tale. And behind today's optimism waits tomorrow's uncertainty. The story of 1929 reminds us that markets can change faster than we imagine. The lessons of 2008 warn us that stability can vanish overnight. The choices investors make today will shape their financial futures for decades. In this moment of historic highs and global chaos, discipline matters more than ever. Because true financial security is not built on excitement, but on wisdom, preparation, and restraint. So, as the S&P 500 touches record levels and headlines celebrate endless growth, one question remains in the mind of every careful observer. Are we witnessing the start of a new golden age, or standing at the edge of another devastating fall?